Hello and welcome back in my new video. So I have to warn you before we start that this video is mostly aimed towards newer investors, not really seasoned ones, although there's always something to learn for everybody. So even if you are a seasoned investor, you may want to keep on watching because there may be some interesting things to hear and expand your knowledge in some situations. So today I wanted to talk a little bit about mutual funds, index funds, ETFs, and why they are good and why they are so trendy and why people actually like them a lot. What's the appeal with them and what do they do for investors? How do they help us make money? Now, when we're talking about a mutual fund, what a mutual fund actually is, it's solely a basket of different investment vehicles. So it could be a basket of stocks and a basket of bonds or a basket of real estate funds or a basket of all these together. So it doesn't have to be necessarily stocks. It could be a combination of stocks and bonds, for instance. And the point of that is that instead of us as investors having to buy, let's say, 100 different companies, we can just own a fund, one fund that tracks all these 100 companies. And you may be thinking, why not just go ahead myself and buy all those stocks that I want to hold? And yeah, you can do that, and it's potentially a good idea. The thing is, it's a little bit time consuming and a little bit tough to actually update all your investments based on your indexes or indices or based on how they are doing. So you can definitely do it if you are an active investor. But the concept here is that you can buy a fund and have that performed passively for you, so that you don't really have to spend your time. Now, there are two types of funds. There are mutual funds that are actively seeking to make profits, like adding more and newer stocks and better performing stocks to their portfolios, removing some. And these are called like active funds. And there are also passive funds, like this one that I'm pointing here on the screen, the VOO, which is the Vanguard S&P 500 ETF. And this one tries to track the performance of the S&P 500 index. And to do that, it actually buys the stocks that are included in the S&P 500 index. That's what it does, in the exact weighting that they are included in the S&P 500 index. And so by doing that, it's actually a very, very passive investment. So there's nobody that needs to actually think about which is the next best thing, what is the next best stock to buy. It's not active. They just follow what the index has. And so whenever the index gets updated, they just update the fund and that's it. But when we're talking about actively managed funds, mutual funds, these ones are actually have financial advisors that advise on what is the next best stock to buy. And so they could be wrong or they may not be wrong, may be right in some situations. Generally speaking, most funds that are actively managed do not make as much as a very simply not managed passive fund like the S&P 500 fund that I'm showing here. And one of the main reasons for that is the fact that they actually charge a little bit more than, actually potentially a lot more than passively not managed, passive funds basically. And so they just don't charge that much when we're talking about passive funds. Their expense ratio, as we call it, is very, very low. It could be like 0.04% or something of that sort. And so it's almost negligible for most investors. Now, what is an index fund really? So an index fund tries to mimic the performance of a specific index. So it could be the Dow Jones, it could be Nasdaq, it could be like the Brazilian market, or it could be the bond market, for example. And so the way to do that is by holding these financial instruments that are held within that index, that specific index. And so, for instance, if we're talking about the S&P 500, it consists of the biggest, actually they're not all the biggest companies, they're not all the highest market capitalization companies, but they're pretty close to that. They're very, very big in terms of market capitalization companies in the US. And so this one holds 500 of those in a specific weighting, just because some of them specific weight, just because some of them have a higher market cap, so it actually tries to adjust for that. And so you'll see, for example, that Apple has a very high weight when you compare it to other lower and much less famous stocks and companies. And so what this does is basically holds all these companies in proportion and tries to follow what the index itself does. And you will see here, if we take a look at this specific fund, which is the S&P 500 one, this is actually an ETF. It's not even a mutual fund. But the differences are very, very small. It's practically speaking, it's the same thing. The main difference really between an ETF and a mutual fund is that the ETF is actively traded in the market. So you can trade it in market hours. However, the mutual fund, you cannot trade it when the market is actually active. It's only traded once when the market is closed. That's mainly the difference. So ETFs tend to be a little bit more volatile because of that. And that makes a lot of sense just because they are instruments that can be traded. And so if we're talking about the S&P 500 here, you can use Vanguard, which is a pretty awesome website in order to discover the performance of mutual funds and index funds and all that. And you can see here that hypothetically speaking, if you bought this fund in 2011 and added $10,000 to it, today you would actually have $46,000, which if you think about it is a 450% gain in 10 years. Absolutely insane. The market has been reaping in these past 10 years. And so if you added some funds here and just let it grow, just by passively adding funds to an index fund, that's it, without even having to worry what this fund holds, you would have quadrupled your money and then some. And so it's amazing what kind of gains the market has made this past 10 years. It's absolutely amazing. I don't know if that will continue to happen because past performance doesn't necessarily mean that it will be reflected in the future. But based on what we are seeing here, the stock has been performing awesome in the past 10 years. And over here, you can also see the portfolio composition. And another nice thing here is that it's pretty nicely diversified. Of course, there is always some sort of weight depending on what the S&P 500 holds and what are the biggest companies. And over here, the biggest ones are information technology ones. And you will see it in the actual companies like Apple, Microsoft, Alphabet, Amazon. They are all tech companies and they are very, very high in the list, as you would expect, just because their market capitalization, their value, that means, is actually very, very high. And so they have to have a larger weight when you compare it to companies that are smaller. And you can see here all the holdings of this specific fund. And you will see that the market value for these companies is this, in terms of the share count that they have over here. And you will see that as we go lower and lower and lower, and we examine the lesser companies in terms of the market capitalization, in terms of their market capitalization, you will see that the S&P 500 index fund does hold companies like Walt Disney or Exxon. They are just not up there because they are not the highest market cap companies. And so Apple and Microsoft have to have a larger piece of the pie. That's what it is. And so you can use the Vanguard website here to discover some more information about the fund itself. Like, for example, the price of the fund, the performance, how it has been performing over here, and just gain some information and potentially think about whether you want to buy the stock itself, the fund itself. And you will see here that the 1 year performance is 28.6 because last year was amazing. 3 year 26, also amazing. 5 year another amazing period of time, and even 10 years like 16.5%, which is absolutely amazing for an index fund. I mean, normally speaking, these kinds of funds would make about 10% to maybe 8% if you exclude inflation, but 16% over a 10-year period, that's absolutely bonkers. It's insane. It's very, very high in terms of gains for simply holding an index fund. It's amazing. And so this is why it's a good idea to hold such a fund, because there is much, much less risk than holding a specific stock, because this one has a collection of 500 stocks and quite a few of them. Again, different ways, but still a lot of different stocks. So if one goes bad, you have the others to compensate. And you can see some more information here about the diversification and all that. Yeah, not every sector is included in the same balance, and you would expect that again, just because the market capitalization changes based on the highest performing sectors in the market in the past 10 years or so. So you would expect that. You would expect to see that, I mean, tech companies have been ripping, and so this is highly expected. And the last thing I wanted to point out here is just show you some things in Coifin, the platform that I'm using for some discovery in terms of stock prices and analysis that I do. Is interesting to notice the dividend yield here, which is 1.22% for the fund, and so it's about it has been higher as well. So you notice that companies, you can actually use this to see that a lot of the S&P 500 companies tend to switch towards growth instead of actually paying dividends and wasting money out of their cash flow. They are actually they tend to be using it for growth. So it may be a growth period this next few years. That's potentially something that points to that. And so you can use a tool like this to actually discover the weights and all that, see some nice diagrams and all that. But what I wanted to point out using this is basically the dividend yield, and just let you know that even if you are holding this fund and it moves sideways, you can still be gaining some nice dividends. 1.22, just holding a very, very safe fund. Just there's almost zero risk here. And so you will notice here that if we date it back to 2010, this has been ripping, moving upwards and upwards and upwards, with some disruptions, yeah, but still continuing upwards. So it's been performing pretty awesome. And now the dividend is obviously not safe at any point. Like, it could go up and down just because there are so many companies that can affect the dividend, the dividend amount that you get, the percentage. And so you're seeing a little bit of a discrepancy here, but that's fine. I mean, you're not getting this for the dividends, really. It's a nice extra. You're getting this because it's a diversification for your portfolio, which includes very, very well-known and good companies that are having awesome cash flows, most of them, or a lot of them, and high market caps. And so you should and are actually safer than just buying, like, let's say 5 stocks with your money and betting that all these 5 are going to go up. Instead, you can buy this basket that has 500 stocks and be sleeping better at nights. Now, I don't just recommend that people invest only in index funds if they are seasoned investors, or if they want to become seasoned investors, or if they want to learn more about investing. It's always a good idea to understand how to read the financial statements of a company, because it can be much, much more lucrative to buy a company that's doing well and it's underpriced. That's essentially what a good investor is trying to do. Find awesome companies that are currently underpriced. That's the whole point. And so, regardless of that, for a safer fund, some safer investments, which you should still be holding, because at some point everybody wants to retire and have some money that they can use for retirement that are safe. This is a kind of fund that you could definitely use to gain some safe money over the years, and just have it double itself without even look at it in like 7 or 8 years or so, every 7 or 8 years. And then just use some of your active funds, the ones that you can afford to potentially lose a little bit more of, and just use it to buy some companies that have a lot of potential, and the market right now is undervaluing or is not valuing effectively, or they are not hyped enough yet. This is what you're trying to find as a good investor, and this is what my channel is dedicated to. I'm trying to help you discover the stocks that are not well known, yet they are potentially are going to be the high performance of the future. So they're going to be having high performance in the future. That's what I'm trying to do. I want to buy cheap today and reap the yields later and make some money later. So this is what I wanted to talk about in this video. Hope you enjoyed it, and if you were a new investor, maybe that helps you a bit with your new investments, and I hope that you invest well and you make a lot of money in the future. And if you did enjoy the video, you may watch this one that I made about Lucy Group, in which I'm discussing the company and whether it's worth buying for the stock. And thank you for watching this one. Have an awesome day and an awesome week. Bye bye.